Billionaires don't just make money, they know exactly how to protect it. While most people pay taxes straight up, the ultra-wealthy use clever loopholes, strategies, and systems to keep billions in their pockets. In this video, we're breaking down the top 10 tricks billionaires use to avoid taxes. Not rumors, but real methods that show how money and power work at the highest level. Before we dig in, don't forget to like, subscribe, and tap the bell. Because understanding these strategies isn't about copying them. It's about knowing how the system really works. 10. Residency and citizenship planning. Many billionaires relocate to states with no income tax, like Texas, Florida, or Nevada, saving millions annually. Some go further, renouncing U.S. citizenship to avoid global taxation, though this requires paying exit taxes. Others establish residency in countries with favorable tax treaties or territorial tax systems, structuring their affairs to minimize worldwide tax obligations while maintaining business operations globally. 9. Strategic loss harvesting and carry-forwards. Billionaires strategically realize losses to offset gains, carrying forward unused losses indefinitely. They might sell losing positions before year-end while simultaneously buying similar assets to maintain market exposure. This tax loss harvesting, combined with the ability to carry losses forward, allows them to shelter future gains for years or even decades. 8. Private placement life insurance. Ultra-wealthy individuals use specially designed life insurance policies as tax-sheltered investment vehicles. They fund policies with millions in premiums, investing in hedge funds and private equity within the policy. The investments grow tax-free, and they can access funds through policy loans without triggering taxable events. This creates a permanent tax shelter that passes well to heirs completely tax-free. 7. Installment sales to grantor trusts. Billionaires sell appreciating assets to trusts they control, receiving payments over time at government-set interest rates. Since they're both buyer and seller for tax purposes, no gain is recognized initially. The assets and all future appreciation transfer to heirs at frozen values, while the billionaire receives steady payments. This strategy works exceptionally well, with assets expected to outperform the government discount rate. 6. Conservation easements. This sophisticated tax strategy revolves around donating development rights on privately owned land to conservation organizations, while still retaining full ownership. Essentially, billionaires purchase large tracts of land, often in areas with significant potential for development, and then grant a conservation easement, a legal agreement that permanently limits how the land can be used. By doing so, they protect the land from future development while still maintaining control over its day-to-day use. The financial benefit comes from the valuation of the easement. Landowners can have their property appraised at significantly higher values before donation, and the difference between the land's unrestricted value and its restricted value is claimed as a charitable deduction. This can translate into massive reductions in taxable income, sometimes reaching tens of millions of dollars for ultra-wealthy individuals. While some have abused this strategy in the past, leading to increased IRS scrutiny and crackdowns on fraudulent easements, legitimate conservation efforts remain highly effective. When done properly, these strategies not only provide significant tax savings, but also support environmental preservation, protecting forests, wetlands, and other ecologically important areas for future generations. 5. Corporate inversions and tax haven strategies. Many billionaire-controlled companies use complex international structures to minimize global tax rates. They establish subsidiaries in low-tax jurisdictions like Ireland, Singapore, or the Netherlands, then use transfer pricing and licensing agreements to shift profits offshore. Apple famously used the double Irish-Dutch sandwich structure, while other tech giants employ similar strategies to achieve effective tax rates well below statutory rates. 4. Opportunity Zone investments. Opportunity zones, introduced under the 2017 Tax Cuts and Jobs Act, have quickly become a cornerstone of sophisticated billionaire tax planning. These specially designated areas are designed to encourage investment in economically distressed communities by offering exceptional tax incentives for investors who channel capital gains into qualified funds. By placing previously realized gains into Opportunity Zone funds, investors can defer paying taxes on those gains until 2026, effectively turning short-term taxable events into strategic long-term opportunities. The benefits don't stop there. If the investment in the Opportunity Zone Fund is held for at least 10 years, any additional appreciation generated by the investment can become completely tax-free, offering an extraordinary pathway for wealth growth without future capital gains taxation. This structure allows billionaires to simultaneously achieve financial growth and contribute to community development, creating a unique combination of profitability and social impact. 3. Family Limited Partnerships. This strategy involves creating partnerships with family members to transfer wealth while minimizing gift and estate taxes. Billionaires contribute assets to the partnership, then give limited partnership interests to children at discounted values. Because these interests lack control and marketability, they're valued at significant discounts, sometimes 30 to 40% below fair market value. This allows massive wealth transfers with minimal tax consequences. 2. Charitable Remainder Trusts. Billionaires establish these trusts to receive income for life while getting massive tax deductions up front. They transfer appreciated assets into the trust, claim a charitable deduction based on the remainder value, and receive payments for decades. After death, whatever remains goes to charity, but they've already extracted most of the value tax efficiently. This strategy allows them to turn a tax liability into a tax deduction while maintaining cash flow. 1. Buy, Borrow, Die strategy. This strategy is often called the holy grail of billionaire tax planning, and it has been perfected by some of the world's wealthiest individuals. Rather than selling appreciated stocks and triggering hefty capital gains taxes, billionaires leverage their holdings by borrowing against them at incredibly low interest rates. This allows them to access large sums of cash without ever liquidating their investments, keeping their wealth growing uninterrupted and largely tax-free. The borrowed funds are then used to maintain a luxurious lifestyle, invest in additional ventures, or finance charitable giving, all while the underlying assets continue to compound over time. This approach effectively separates income from wealth, allowing billionaires to enjoy liquidity without diminishing their principal holdings or paying taxes on capital gains. One of the most famous practitioners of this method is Warren Buffett, who has lived comfortably for decades using borrowed money against his shares in Berkshire Hathaway. While his investments continue to grow tax-free, he avoids unnecessary tax payments during his lifetime. From offshore accounts to borrowing against their wealth, billionaires prove that when it comes to taxes, knowledge really is power. Which strategy surprised you the most? Drop your thoughts in the comments. I'd love to hear your take. If this breakdown opened your eyes, hit like, subscribe, and share it with someone who's curious about money and power. Until next time, stay smart, stay informed, and always know how the game is played.